Hey guys, it's that Dividend guy coming at you with another stock list video, this time featuring Kiplinger. These are the 16 best value stocks for the rest of 2021. And as you guys know, I am a deep value investor. I look for quality companies at quality prices, and so this is a little bit of a longer list than I normally do, but I want to find lists like this because they give me options and they broaden my horizons when it comes to finding stocks. A lot of times I find really good value stocks in longer lists like this, so this is a great way to find new investments. So let's jump right in and take a look at the first stock. So first, I believe we have Kroger. Is one of the world's largest food retailers, operating over 2,700 grocery stores, 1,500 supermarket centers, and 435 distribution centers across the U.S. It serves nearly 11 million customers on a daily basis. The company owns 170 jewelry stores under the Fred Meyer and Littman Jeweler brands. Kroger generated 14.1% growth in the same-store sales last year and a 58.4% improvement in adjusted earnings per share. Kroger rewarded its investors with a 13% dividend hike and a $1.3 billion share repurchase program. Given the difficulty in its pandemic-driven share price returns, Kroger offered guidance for the year 2021 on a 2-year stack basis, which includes the sum of last year's actual results and this year's forecasts. Said Kroger's targeting 9 to 11% growth in the same-store sales using its 2019 results as a base, and a 12 to 16% increase for adjusted EPS. Kroger has continued to gain market share as the pandemic ebbs due to the company's competitive pricing, and it thinks Kroger's growth prospects remain strong, fueled by its popular private brands and detailed customer analytics. However, Goldman Sachs says that it's worried about the inflation pressures that Kroger may suffer from rising costs. The price of Kroger shares declined after the bearish call. The best value stock in consumer staples started trading at 14 times forward price to earnings ratio, and nearly 40% discount to its peers. In addition to the modest valuation, Kroger has a solid balance sheet with an abundant free cash flow, which is the cash left over after capital and expenditures, dividend payments, and financial obligations are met, and an 11% dividend growth over 5 years. Additionally, it has an ultra-safe 26% payout ratio, which in proportion of earnings is the company that in proportion of earning a company pays its shareholders in the form of dividends. So guys, it only pays out 26% of its profits after all the bills are paid. So it's got a crazy low payout ratio, a great PE ratio at a value stock is about 15. And the last dividend increase, I believe, was about 17%. So, guys, this is a great value stock with metrics. It's got a great pandemic-friendly business model. People need groceries regardless of what the economy is doing. And given its scale, Kroger is a monster in this space. It might not be as popular as a Target or a Walgreens, but it still has pricing power, and they are very, very well positioned after the pandemic to really take advantage. And as they said, they had huge growth, but they're not going to stop investing in their businesses. I've seen a new video by Dividend Data that they just purchased a delivery food chain. They've also revamped some of their. They're kind of doing an Amazon type thing where they have distribution centers as well. So they really are investing in the future when it comes to this space. And it is a very good deep value play with high growth potential. I already own 20 shares, so definitely a good value pick. Next, we have Norton LifeLock. Never heard of this. Provides cybersecurity solutions for consumers worldwide. Has more than 80 million customers globally and has a subscription-based model. Serves the fact that more than 330 million people experience cybercrime and over 55 million were victims of identity theft in the last 12 months. So this is definitely a needed service. People are always worried about their identity and their private information being leaked. So the revenues rose 9% during the fourth quarter, which ended in April 2nd. Customer count increased by 2.8 million over the 3-month period, and adjusted EPS improved by 54%. They share their long-term growth strategy for accelerated growth. It includes optimizing and usability of their products and driving sales leads to via paid marketing channels and acquisitions, such as its recent purchase of German-based cybersecurity firm Abbvie. In addition, the company committed to 3 to 5 year financial goals that include double-digit yearly sales growth, estimated EPS of $3, roughly double 2020 levels, and annual free cash flow of $1 billion, which all will be returned to investors, excluding acquisitions. As far as value stocks go, given these ambitious growth plans, the shares will appear undervalued at 17 times forward earnings, and it's priced at a 37% discount to its fellow cybersecurity stocks. Its quarterly dividend didn't raise last year, but the company did reward investors with a $12 one-time special dividend in January. So this one isn't a dividend growth stock, but it is a deep value stock. It's only about $30 a share. I've never even heard of it, but it's one that I can look into. That's why I like lists like this. Next, we've got Huntington Ingalls Industries. HII designs, builds, and repairs military ships for the U.S. Navy and Coast Guard, including the assault ships, surface combatants, cutters, aircraft carriers, and submarines. It's America's largest military shipbuilder and only producer of aircraft carriers for the U.S. Navy, and one of 2 companies that makes nuclear submariners. Over 70% of the U.S. Navy's warship fleet came from Huntington Ingalls shipyards. Its EPS grew over 47% year over year in the first quarter, and its contract backlog rose to a record $48.8 billion. Huntington Ingalls' significant contract awards so far in 2021 include $2.9 billion for the overhaul of the nuclear-powered aircraft carrier, and a $250 million deal to provide support to Naval Informative Warfare, Central Pacific Intelligence Services, Reconnaissance Department. Additionally, it won the option of an existing U.S. naval contract to construct a 10th nuclear submarine and inked a $302 million contract with the Naval Sea Systems Command. It's earned a spot as one of the best value stocks for investors, seeing a 19.3 compound annual growth rate for EPS over the past 10 years. Plus, it's brought in a 568% total return over the same time frame, more than twice as much as the S&P index. This defense contractor has also delivered 8 consecutive years of annual dividend growth rates, averaging at an annual 18.6% over the last 5 years. Its shares are attractively priced at a 16.7 times forward earnings and a 22% discount to industrial sector peers. I've never even heard of this company, but I mean, it sounds like a really, really safe company. If you're involved in any shape, way, or form with the military, your profits are pretty safe. So that's definitely one I should look into. Next, we've got Tyson Foods. Everybody's got to eat, right? So Tyson Foods, ticker symbol TSN, produces 20% of beef, pork, and chicken consumed in the U.S. It supplies meat to national restaurant chains, club stores, grocery stores, food service customers, and the company's portfolio of brands include Tyson, Jimmy Dean, Hillshire Farms, Ballpark, Wright, Adele's, and State Fair. Protein consumption and gradual recovery from food service industry powered Tyson Foods to a 41% EPS growth during the first 6 months of fiscal 2021. The company also generated $1.3 billion in operating cash flow. Strongly focused on expanding its poultry businesses and recently invested $425 million into new poultry plant in Tennessee. Another growth initiative for the company is a plant-based meat alternative. It's launching a new line of plant-based products in Asia that complement the Raised and Rooted brand. Plant-based burgers, brats, and Italian sausages already sold in U.S. grocery stores. All right. However, I'm not going to worry about that. Tyson has a 9-year record of raising its dividend and has generated an impressive 26% annual dividend growth rate on an average over 5 years, while keeping a payout ratio below 30%. Its shares are conservatively valued at 13 times forward earnings and nearly 40% discount to other consumer staple stocks. So, guys, this is a deep value stock with a 9-year dividend growth rate at above 20%. That's phenomenal. Tyson Foods is definitely a stock that you should be looking into. Everybody's got to eat. A lot of people eat meat, chicken, beef, and pork. So it's definitely one that you interact with even if you don't realize that you do. All right, next we have Bristol-Myers Squibb. It develops life-saving therapeutics in areas of hematology, oncology, cardiovascular, and immunology. Its portfolio has blockbuster drugs including Opdivo, Yervoy, and Abraxane for cancer, Revlimid, and Pomalyst for blood disorders. I'm not going to go through all those, but the acquisition of Celgene in 2018 and Kadira in 2020 added important new drugs to its portfolio, including a drug for chronic heart disease and more cancer drugs. It is well poised for more M&A activity, judging by its strong balance sheet and rising free cash flow. The company ended the first quarter with $13.2 billion in cash versus net debt of $33.1 billion on its balance sheet. Over the next 5 years, it is committed to delivering double-digit revenue growth, continuing operations of $3 billion of operating synergies into integrated acquisitions, and $45 to $50 billion in free cash flow. The company is also guiding for 2021 EPS of $7.35 to $7.55, up 16% and a mid-range from last year's results, and easily it covers the annual dividend payment of $1.96 per share. As far as value stocks go, the shares look especially bargain priced at 63%, at a 63% discount to healthcare competitors and a low PE of 9. In addition, the company has delivered 14 years of consecutive years of a dividend growth, including a 9% hike in 2020. So a pharmaceutical that is very, very well poised for great free cash flow and great dividend increases. Last year was a 9% growth rate. Or a 9% increase to the dividend. So definitely a good kind of under the radar. I don't see Bristol-Myers Squibb talked about a lot. It's one of the less popular pharmaceutical stocks, but it obviously has the free cash flow to be a decent contender and has almost a double-digit dividend growth rate and double digits worth of dividend increases, sitting at 15 years of dividend growth, or 14 going on 15 years of dividend growth. Next, we've got Merck, another pharma company. It's best known for Keytruda, its blockbuster cancer drug, with annual sales exceeding $14.3 billion. It's a top-selling drug worldwide, second only to Abbvie's Humira, but unlike it, whose patent is up in 2023, it has at least 7 more years of patent exclusivity. So Merck's portfolio is safe for 7 years, which is a long time in the drug market. Keytruda sales are up 19% year over year. Merck's animal health business performed strongly with 17% sales of Gardasil and other vaccines fell due to fewer wellness visits during the pandemic. Overall, Merck delivered flat sales and disappointing 7% annual decline in adjusted EPS for the first quarter. It's largely sat out the pandemic, discontinuing development of its own COVID-19 vaccine in January, although the company continues to work on an antiviral pill for treating those who get the virus. So they were actually in the lineup for a COVID vaccine, but they didn't finalize it. So the recent spinoff of its women's health business as a separate publicly traded company triggered a downgrade, which of course it did. Anytime a company spins something off, the profits drop as well. It reduces the company's operating margins, although the deal also frees up capital it can reinvest into the pipeline. Despite recent challenges, it has generated a respectable average of 11.2% of annual EPS growth and a 7.2% dividend hike over 5 years. Dividend payments have also risen for 11 years in a row. Other strengths include plenty of cash, $7 billion, and a robust free cash flow generation of $8.9 billion in the past 12 months. The stock's valuation is also attractive. Merck shares trade at 12 times forward earnings, at a 49% discount to pharma industry peers and a 218% below its 5-year historical forward PE. So guys, what you get with Merck is a company that sounds like it's got a little bit of a rocky start to the year, just due to the fact that they are not in that COVID lineup, but they have the second best-selling drug in the world behind Abbvie's blockbuster drug. They have great free cash flow, 11 years of consecutive growth. They're a great company. Even Warren Buffett bought them. So you're in good company. It's a great pharmaceutical play that, again, just like Bristol-Myers, I don't see a lot of people talking about Merck. So a great value stock right there as well. Next is General Mills. Again, people have to eat regardless of the economy. So General Mills makes cereals, Cheerios, and Chex, yogurt, Yoplait, ice cream, Hennigan Days, and other foods, 8 of the company's brands each generate over $1 billion in annual sales. It hit a home run with its Blue Buffalo pet food business, which has been delivering double-digit sales growth. The company expanding into pet food franchise by acquiring Tyson Foods pet treats business. During the pandemic lockdown, it benefited from significant increase in meals eaten at home, which fueled double-digit percentage growth in EPS for fiscal 2020. It's created a difficult year-over-year comparison during the fiscal 2021. The company generated only 6% year-over-year adjusted EPS growth during February's quarter, falling short of analyst estimates. Despite these challenges, I don't want to read that. It's just talking about analyst expectations for the stock. For those seeking out value stocks with dependable dividends, General Mills is one to watch. Although it hasn't increased dividends every year, it hasn't missed a dividend payment in over 120 years, with an annual growth of only 2.6% over 5 years. But the shares are valued at a 17 times forward PE multiple and a 22% discount to their consumer staple peers. So guys, General Mills doesn't do regular dividend increases, but they do have a very consistent dividend. So you don't get a lot of growth here, but you do get consistency. But the problem with that is if you're buying General Mills for they have consistent profits, but they don't translate that into dividend payments. And what that means is if you have money sitting in General Mills for a considerable amount of time and they don't at least match inflation with that dividend payment, you're actually losing money to inflation. So it's not a bad company. Like I said, everybody has to eat. They said they had multiple billion-dollar brands, but if those aren't generating enough free cash flow to boost up the dividend every year, it might be one that you might want to avoid. Yes, it's a good value play at a 17 PE, but if it's not giving you that cash flow generation year over year and not increasing, then you might want to stay clear. Next is RentACenter. It provides lease-to-own options for consumers on a big-ticket items such as furniture, appliances, computers, and consumer electronics. It operates approximately around 2,000 stores across the U.S., Mexico, and Puerto Rico, as well as 460 franchise locations. It acquired Acima Holdings for $1.65 billion in cash and stock. It works with partners to provide financing to rent-to-own customers at more than 15,000 retail locations. This acquisition will make RentACenter better able to compete with national accounts and upgrade its rating on a value stock to a buy. It's helped the Acima sales contributed to help RentACenter increase revenues by 25% and boost same-store sales by 23% and lift the adjusted EPS by 97%. The company also increased its guidance for 2021. RentACenter reinitiated quarterly dividend payments in 2019 after financing its debt and hiked its annual payment by 16% 2020 to 7% 2021, while the company's debt is still relatively high at 69% of capital on a trailing 12-month basis. The payout ratio is conservative at 36%. Provides a margin of safety for the dividend. Shares are valued at 11 times PE, and its forward PE multiple is at a 36% discount to other consumer discretionary sector stocks and a 47% discount to the company's 5-year historic forward PE. Next is NRG Energy. It provides electric and natural gas to more than 3.7 million residential small businesses and industrial customers. Company mainly serves customers in Texas, but also has a sizable presence in the Northeast. It acquired Direct Energy, a leading retailer of electricity and natural gas across the U.S. and Canada. This acquisition adds more than 3 million retail customers and $70 million of annualized adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, to NRG's operations. A severe weather storm last February hurt the company's Texas operations and is expected to reduce its cash earnings by $500 to $700 million. Despite this, the company is guiding for $2.4 to $2.6 billion of EBITDA this year, up from $2 billion. It remains on track to realize $137 million of acquisition-related synergies in 2021 and will rise to $300 million by 2023. However, the reduction of cash earnings caused NRG to extend its deleveraging plan to an additional year, and the completion is now targeted for 2022. The company plans to raise cash through a $700 million sale for some generating assets to its eastern and western regions and and the $202 million infrastructure of its remaining stake in its solar project. Based on its dividend, NRG increased its dividend by 8% in 2021, despite the storm-related hit to its 2021 cash earnings. The company's dividend appears to be relatively safe. Payout ratio from adjusted EPS is estimated at 26%. This year, the cash flow payout is just 23%. As far as value stocks are concerned, its shares are at a bargain, priced at 7 times forward earnings, a 62% discount to utility industry peers, and a 40% discount to the company's historic 5-year PE. So this is a very deep value stock. Next is Verizon. It is one of the country's largest wireless providers and serves 94 million wireless subscribers and 13 million internet, TV, and landline accounts. Like other wireless carriers, Verizon is making massive investments in 5G. The company is spending more than $53 billion to build out its ultra-fast 5G wireless network, and its budgeted spending of $18 billion on network equipment related to infrastructure this year. It plans to power the 5G network with C-band and multimeter wave spectrum-acquired auctions this year. It's likely to raise to 50 million households with 5G coverage range by late 2025. To help the fund, they decided to sell assets that include AOL and Yahoo for $5 billion, while retaining a 5% or 10% stake in the media businesses. Verizon bid nearly $7 billion last year to acquire TracFone, a leader in prepaid wireless services, in a deal expected to create significant cross-selling opportunities. Verizon expects to convert some of the TracFone's 20 million customers to more profitable post-paid services. The acquisition has been scrutinized by the FCC regulators, but Verizon believes the transaction remains on track to close in the second half of this year. Verizon has increased dividends for 14 years in a row, and a dividend hike could happen later this year. 5-year dividend growth has been relatively modest, averaging just 2% annually, and Verizon's payout ratio is a relatively high 49%. The company's high debt is also concerning. Verizon has a total debt of $180.7 billion and a 223% ratio of debt to equity. The large debt load could limit dividends and 5G spending. However, these risks appear already priced into the stock, which trades at a low 11 times forward PE and a 47% discount to industry peers. Next is Abbvie. It's best known for Humira, the world's top-selling drug. In hopes to offset its declining revenues caused by biosimilar competition, it has other drugs in the pipeline. I'm not going to go through all those, but it is also supplementing its in-house drug pipeline with acquisitions. The purchase of Allergan roughly 1 year ago added Botox, a best-selling drug, an aesthetics market, and eye care drug, Restis, to Abbvie's portfolio. Due mainly to the acquisition, Abbvie's net revenues rose 51% year over year during March quarter. Adjusted EPS grew 22%, and the company also increased its guidance, targeting 18% growth at a midpoint, and expects to launch more than 24 new drugs over the next 2 years, including 5 expected approvals in 2021. The free cash flow machine generated $18.5 billion in free cash flow over 12 months, and it is spending $550 million to acquire Sulton, known as Resnick, a non-invasive device for improving the appearance of cellulite, and the new device complements Abbvie's existing portfolio of body sculpting treatments it acquired with Allergan. I'm not worried about the analyst expectation, but despite 9 consecutive quarters of beating consensus and analyst estimates, fears about the sales decline of the biggest drug, Humira, are causing Abbvie shares to trade at a 9 times forward PE, 63%, 9 PE is insane, 63% discount to pharma industry peers, and a 17% discount to the historical forward PE. Abbvie also offers a considerable yield at 4.6%. That is 3 times that of the typical healthcare stock. So Abbvie is a great, not only is it a great dividend player because it's had great dividend growth, has a great yield. They're smart about their acquisitions. They just bought Botox, and now they're getting another they're buying another company to help with that acquisition. So they're smart about their acquisitions. They have the free cash flow to do so. Plus, they have great dividend hikes as well. So, love Abbvie. I own 60 shares. Next is Prudential Financial. I've looked into them before. They have been selling insurance annuity investments for over 140 years and currently serve more than 50 million customers worldwide. The company manages approximately 1.7 trillion in assets under management and is among the world's top asset managers. Prudential ranks among the top providers in global group insurance, annuities, and individual life insurance. The company plans to boost profits by increasing efficiency, trimming $750 million from annual costs over the next 3 years, de-risking its business, and reallocating 5 to 10 billion in capital to become less interest rate sensitive. This more than 5.5 billion in new capital flowed in the asset management business in the first quarter. It rose 85% to $4.11, greatly exceeding analyst census estimate of $2.75 per share. Over the next 2 years, it plans to return $10.5 billion to investors via dividend hikes and shareholder repurchases. Dividends have risen on an average of 10.9% annually over the past 5 years and increased 5% during the March quarter. What makes this one of the best value stocks is that Prudential shares trade at just a modest 8 times forward earnings, a 32% discount to the financial sector peers. This is one that I do need to look more into. I haven't done a lot of research on Prudential, but I do love insurance. Right now, I own Allstate. I own Allstate, and I also own Aflac, but I do need to do some research into Prudential as well. I've looked into Travelers too, but Prudential's new. I haven't done a lot of research on Prudential. Next is Altria. It's the second largest tobacco company in the U.S., best known for its top-selling Marlboro cigarette brand. It's also a leader in non-combustible tobacco products, Juul, and cigars, Black and Mild. Other businesses include wine sold under the label, a 10%, which they just sold that actually, global beer giant Anheuser-Busch, and a majority stake in the cannabis company Cronos. The company's $12.8 billion investment into e-cigarette company Juul has been a disaster due to regulatory restrictions, which, yeah, of course, I'm not going to read all that because it was just a really bad acquisition. Its March quarter fell 5%, declined by approximately 2% as a result of the continued declines in the sales of smokable products, which were only partially offset by higher oral tobacco and wine sales. The company is guiding for an EPS of $4.49 to $4.49 to $4.62, up 4.5% in the point of next year. Altria has increased its dividend for 55 times in 51 years. The last annualized dividend hike was 2.4% approximately 1 year ago. The company targets a payout ratio at roughly 75% of its EPS, which rich payout is made possibly by reoccurring nature of MO sales and the company's sizable free cash flow. Alright, I'm not going to read all that. The stock is valued at 11 times forward PE, 50% discount to consumer staple peers, and a 27% discount to the stock's historical forward earnings. Next is Unum Group, another insurance company. Yep. It provides group disability, life, accident, and critical care insurance for more than 39 million customers in the US and the UK and Europe. The company sells its group insurance plans to more than 55% of the Fortune 100 companies and is the world's largest provider of disability insurance. Its primary brands are Unum US, Unum International, and Colonial Life. It was hit hard by the pandemic due to the death of COVID-19, causing a spike in benefit payouts. In addition, lower interest rates, trimmed investment returns, and high unemployment rates resulted in many employer-based plans being canceled. The company's net income fell by 28% in 2020, and shares dropped more than 20% as well. Alright, so it is looking to generate an EPS of $4.70 this year, raising 14% to $5.37 in fiscal year 2022. The company has a 22-year record of paying dividends and has increased dividends 12 years in a row, signaling its confidence in late 2021. It rebounded and hiked its dividend by 5.3% in May. The stellar balance sheet and cash flow on hand of $1.3 billion enhances dividend safety and provides capital Unum can redeploy to take advantage of rising interest rates. Its shares are compelling as far as value stocks go, trading at 6.5 times forward earnings and a 47% discount to their financial sector peers. Next is Ryder System. It's a trucking and logistics company. that provides dedicated transportation and commercial fleet management services. It includes vehicle leasing, renting and maintenance, warehousing, freight brokerage, last mile delivery, and vehicle sales across North America and the UK. It manages a fleet of 235,000 commercial vehicles and owns 300 warehouses and enables companies to deliver direct to 95% of customers in the U.S. in less than 2 days. The largest business segment, Fleet Management Solutions, offer truck, tractor, and trailer leasing for companies that want to outsource their delivery services. COVID made revenues drop by 5.7%, and it's poised for a rebound. The company's adjusted EPS rose $1.09 this year, compared to a per-share loss of $1.38 in the year prior. Its guidance is up roughly 30% to $5.50. Consensus analysts estimate that they're looking for an adjusted EPS of $5.83. All right. Ryder hiked its annual dividend 15 years in a row, including a 10% increase in 2019. The company kept its dividend steady in 2020 due to the COVID-related uncertainties, but they will resume dividend growth soon. The company's high leverage is a bit concerning, but Ryder's reduced debt to equity from 293% to 280% during 2020, and expects the ratio to fall to a low end of 250% in 2021. The percentage of free cash flow Ryder's debt appears to be manageable at just 3.8 times a ratio to trailing 12 months free cash flow. And lastly is UPS. Another great value stock. This freight and the delivery logistics giant operates in over 200 countries and owns or leases a fleet of 127,000 trucks, delivery vehicles, and 570 aircrafts. It delivers an average of 24.7 million documents and packages on a daily basis and provides its mettle in early 2021 by delivering over 196 million doses of the COVID-19 vaccine with a 99% on-time delivery. The company has been firing on all cylinders with double-digit growth in the U.S. and international delivery segments, supply chain, and freight segment. Overall, revenues rose 27% year over year, and EPS improved 141%. It also generated $3.7 billion worth of free cash flow during the quarter, which it plans to use to pay down the $2.5 billion in debt in 2021 while investing $4 billion in growth initiatives. The company is committed to reaching $100 billion of revenues by 2023, up 18%, and investing approximately $14 billion in growth initiatives and achieving a 26 to 29% return on invested capital. UPS shares trade at 18.5 times forward PE and a 14% discount to their industrial sector peers. The forward cash flow basis, the stock trades at 11 times the multiple and 28.4% discount to its peers. The company has either maintained or increased the dividend every year since going public in 1999. The last hike came in February when UPS raised its annual payment by 1% and achieved its 12th consecutive year of dividend growth. Dividend increases over the last 5 years have averaged 5.5% annually. So guys, out of these 16 stocks I own, let me go back through. Sorry, there's a lot of stocks in this one. I own Altria. I almost own Prudential. I own Abbvie. Currently. What else? Don't own RentACenter. Don't own General Mills. I don't own Merck. Don't own BristolMyers Squibb. Don't own Tyson Foods. Don't own that one either. I own three stocks out of the 16. But guys, let me know if there are any stocks that you guys own or any stocks that sounded interesting on this list. I myself found a couple that I will be looking into, but these were 16 of the best value stocks for the rest of 2021. So I own Kroger. I also own Abbvie. I think I bought Abbvie at a really good price, but there are a lot of good value stocks on this list, guys. So if there are any that you sound interested in, make sure you let me know down in the comments below. I definitely want to look into that naval ship one because that one is insane. The cybersecurity one sounds pretty decent as well. So there are a lot of good ideas here, and that's exactly why I look at lists like this. So thank you guys so much for watching. I know it's a little bit of a longer video, but I did want to go into the estimated revenue growth, free cash flow, and stuff like that. I wanted to read the meat and potatoes of the article because a lot of times if You go for value stocks, they do have some issues. There's a reason that they're at a value, but a lot of those picks were short-term stuff because of COVID. So thank you guys so much for watching. Remember to hit the subscribe button, and when you do, hit the bell notification so you don't miss any updates. I do a portfolio update, and I try to do a list video as well every single day. I try to get 2 videos out. So if you guys like consistency here on YouTube, make sure you hit the subscribe button. Make sure you hit the bell notification so you don't miss any updates. Thank you guys so much for watching, and I'll see you guys tomorrow with another list update. Take care, guys.